Hello, everyone. Thanks for joining us this afternoon. I'm Doug Bennett, Acting Director of the New York Tech Alliance. In a few minutes, Paul Ellis, Managing Partner at Paul Ellis Law Group, will begin today's event and introduce our esteemed panel. Before that, I'd like to share a few items regarding today's event and the New York Tech Alliance itself. For anyone joining us for the first time, the New York Tech Alliance is a nonprofit organization serving over 60,000 members in the New York tech community. At the core of our mission, we drive access, equity, and inclusion to make the New York tech ecosystem the most diverse and dynamic in the world. To learn more about us and how to engage, visit our website at nitech.org. Please know that we record our events to share the experience with those unable to attend. Recordings are posted on NYTA's YouTube channel. To view this and past recordings, you can visit youtube.com/New York Tech Alliance. Special thanks to our annual sponsors who help make events like this one possible. Each has a presence on our website. You can learn more about them and how they support our community by going to nitech.org/sponsors. We have a couple of upcoming events. Wednesday, June 22nd at noon Eastern Time. Our Founder Spotlight series will occur. Tara Falcone, CEO and founder of Reason, will be featured, and this is sponsored by Northwestern Mutual. On Tuesday, July 12 at 5:30 p.m. Eastern Time, New York Tech Meetup will occur. And to learn more and register, please go to nitech.org/our_events. And lastly, we love and welcome support to help us produce and deliver our programming. 3 ways you can support us. Add a donation when you RSVP for one of our virtual events, become an individual supporting or corporate member of the New York Tech Alliance, or simply make a small donation. You can do so by going to nitech.org/support_NYTA. And with that, I'd like to introduce Paul Ellis. Hey, Paul, thanks for being with us today and organizing a great discussion and panel. Welcome.
Thank you, Doug. Welcome all. Pleased to have a great turnout today. Again, my name is Paul Ellis. I'm a board member at Tech Alliance. I run these events on legal and financing issues for startup companies, and I'm the managing member of Paul Ellis Law Group. We have a great event this evening. Again, the title, VC Update 2022, Strategies for VC Financing in the Current Economic Climate. For our panel today, we'll have Amanda Herson, Principal of Founder Collective, Travis Milks, Managing Partner of Topmark Partners, Gabby Munoz, Managing Director of Hearst Ventures, and Alan Wink, Managing Director, Capital Markets, Eisner Advisory. So we're really pleased to have such a great panel. They bring a diversity of perspectives. We have early stage venture funds, we have growth stage funds, we have funds located in New York, outside New York. We have Alan, who is in the accounting world and does a lot of work with Eisner Advisory from that perspective. So we have a lot of good perspectives on today's topic. In order to get started, we're going to go around the screen quickly, do introductions, and then we'll get into the content. So again, my name is Paul Ellis, managing member of Paul Ellis Law Group. We are a 10-person firm in Midtown Manhattan. We do a lot of work with early stage tech startups, as well as venture capital funds. Our clients are looking to us to bring them cost-effective, efficient solutions to their legal problems so they can focus on growing and building their companies. In addition to venture capital and financing work, we work on the life cycle of issues facing startup companies, such as formation, employment agreements and equity plans, intellectual property protection, general operations, and mergers and acquisitions and other exits. All of our attorneys come out of top law schools and major firms, so we're able to bring the expertise of big firms with the more efficient cost structure and personalized attention of a boutique firm. I'm going to have office hours today, this afternoon, and the next few days. So if I'm not able to see you in the networking after the event, make sure you go to my calendar link, which is going to be in the chat, and feel free to set up a time to talk over the next few days. With that, I will turn it over to Travis.
Sure. Thanks, Paul. Again, I'm Travis Milks, managing partner with Topmark Partners. Topmark Partners is based in Tampa, Florida. We are a growth equity firm focused on growth stage businesses, generally in the $3 million and up revenue range. These businesses are technology-enabled businesses that are typically led by domain experienced entrepreneurs and teams. For us, we are very much focused on companies that are, of course, rapid growth and have typically a recurring component to their business models and have a B2B aspect as well to their business models. So we invest in a lot of enterprise software businesses and a lot of companies at the intersection of healthcare and IT. We've been very active in sort of the northeast of the U.S., having invested in probably over a dozen companies spanning from upstate New York through New York City down to the Philadelphia area. And that's comprised of about a dozen or so of the 50 or more so companies that we've invested in over the last 20 plus years. We're investing out of our third fund. Our typical check size is in the range of kind of $2 to $5 million. And very thankful to the New York Tech Alliance and to Alan Wink in particular for the invitation to participate here today. Looking forward to a great discussion.
Thank you, Travis. Gabby?
Hi, everyone. Just again, my name is Gabby Munoz. I'm a managing director at Hearst Ventures, which is the corporate venture arm of Hearst, a large and diversified privately held company based in New York. We have two sides of our business, the media side, which consists of a number of magazines, newspapers, broadcast television stations, and cable networks. And then the other side of the house is three business divisions focused on B2B information services and technology across financial services, healthcare, and transportation. Hearst Ventures has been investing in early stage companies since the mid-90s. We're typically going in at the Series A stage or later, writing checks between $2 and $10 million, and focus on the verticals that Hearst is focused on at a high level. So again, transportation, financial services, healthcare, media and advertising, and then e-commerce. That's kind of a quick overview of Hearst and Hearst Ventures. I've been with Hearst for 9 years in various capacities, most recently joining the venture team in Q4 of 2018. Prior to that, I worked in a combination of financial services roles, from investment banking to growth equity investing, and spent a time working at startups at Rent the Runway for 2 years. So that's all about me.
All right, Gabby, thanks very much. I should have mentioned Gabby, from the corporate venture capital perspective, also brings a valuable another view to this conversation. Alan?
Good afternoon, and thank you, Paul. My name is Alan Wink. I'm the Managing Director of Capital Markets for Eisner Amper. For those of you who don't know, Eisner Amper is a global accounting and advisory firm, about 2,200 people across the United States and 6 international offices. Ironically, last August, Eisner Amper actually took on a private equity investor, Tower Brook Partners, out of London and New York. So we were one of the first professional services firms here in the United States to take on a private equity investor. As I said, I'm the managing director of capital markets. In that capacity, I basically work in 3 different areas: help our clients with capital formation, corporate finance initiatives, mergers, acquisitions, divestitures, strategic alliances, joint ventures, etc., and also help clients to build and execute upon growth strategies for their businesses. So looking forward to the discussion this afternoon. And Paul, thanks a lot for including me.
Thank you, Alan. Our last panelist, Amanda Herson, had a bit of a scheduling issue. She believes she's going to be joining us a bit late. I will tell you that Amanda is a principal at Founder Collective, where she specializes in e-commerce and consumer goods. So we certainly hope that we will be seeing Amanda in a few minutes, but in any event, we will move ahead. All right, so in terms of today's agenda, we have a lot to talk about. We have sort of divided up the subject matter into 4 areas. We're going to start talking about the VC market generally, current status and outlook for the coming months. Then we're going to go to specific advice for founders on securing financing, then specific advice on operational matters, and then finally we'll talk a little bit about diversity in startup VC activity and what people can do, diverse founders, to increase their chances of getting funding. So to jump right in, I guess I will say, what a difference a few months makes. A lot has changed in a short amount of time. That's what we're going to be talking about today. I mean, it's been changing so quickly. Alan Wink prepared slides on the state of the market. Just this morning, we were updating those slides a little bit based upon new data that's come in over the last few days. So the market is changing very quickly. Everybody knows that. And that's what we're going to be talking about today, to understand what that means for you, for your companies, in terms of your operations, your attempts to close financing, and to execute on your business plans. With that, Alan, I'm going to turn it over to you to give us a quick sort of bring down in terms of what the market looks like. Okay.
Yeah, Paul, thank you very much. And you're absolutely right. There have been a lot of changes in the market over the last couple of days and certainly the last couple of weeks. And I think I would have been a lot more bullish giving this presentation last year in June of 2021 than I am in June of 2022. And as you can expect, last year was a record-breaking year in venture capital in terms of capital deployed, exits, fundraising. It was just off the charts, and you can't expect the market to continue to go at that level. And so you're beginning to see some declines in the market. There are some headwinds that the VC market is dealing with, in terms of declining public market performance, inflation like we've never seen, rising interest rates, and economic and geopolitical uncertainty. Q1 of 2021, certainly beginning to see some decline in terms of VC investment. But even with that being said, Q1 was still better than most quarters in the past decade. The IPO market and the SPAC market has come to a grinding halt. There were only 28 VC-backed IPOs in the first quarter of 2022, which is really the lowest level we've seen since Q1 of 2020. When you talk about the public markets, last year was a great year for IPO activity. But if you look at the values of the 2021 IPOs, many of them are trading at values below what the last private round valuation was. And I mean, some of them are 60 to 70% below where the private market valuations were. The good news, fundraising continues to be strong. As you can expect, the best geographies for receiving VC investment continue to be the Bay Area, New York, and Boston. And for all of you NBA fans, I mean, it's highly correlated to the teams that are in the NBA finals this year, except for New York. And I guess, the hottest area for investment, not surprisingly, are things to do with the environment, healthcare, lifestyle, supply chain, Web3, and fintech. And hopefully we'll hear some comments from our other panelists in terms of what they're seeing in the marketplace, later on this afternoon.
Doug,
next slide. In terms of trends in valuation, when I first put these slides together at the end of Q1, things looked like they were certainly going up in terms of valuation of, pre-seed, seed, and, early stage companies. But I think geopolitical events, inflation, rising interest rates, public market declines, worker shortages are all starting to impact valuations in the early stage tech space, unfortunately. Q1 data showed rising valuations for angel, seed, and early stage deals. However, there is evidence of a correction in Q2. Down rounds, which were not very common in the first quarter, are certainly becoming more common in Q2. I think only 5% of completed rounds in Q1 were down rounds. We're seeing much higher numbers in Q2 so far. In 2021, approximately 85% of VC returns came from IPOs. And now with the recent downturn in the public markets, this is certainly going to negatively impact VC-backed exits in 2022 and maybe beyond. And as I said earlier, there is some light at the end of the tunnel because there's still a lot of dry powder out there chasing deals. So without that dry powder, maybe valuations would be declining even faster, but there's certainly a lot of money out there chasing transactions. So that's just a little bit of terms of where we see the trends in valuation and where we see the VC market today.
Alan, thank you very much for that, and agreed. Things are moving very quickly, changing quickly. Doug, we can go back to the topic 1 slide. So in light of that, Gabby, maybe you can start off. Can give us your perspective on the venture side. What's your view of the market? What is it? How is that impacting your investment activity and deal terms generally?
Yeah, it's a really good question. So I would say at the end of last year and early this year, we were seeing deals getting done really quickly at really high valuations. Founders being able to get deals done at 10% dilution, in some cases less than 10% dilution. The valuations were extremely inflated, and deals were getting done really quickly. People would, it wasn't uncommon to have multiple term sheets in the course of a couple weeks. Since then, however, things have definitely started to turn. It's visible. Deals are getting done more slowly. The valuations have definitely come down to, a more reasonable level where founders are starting to again take 20 to 25% dilution on a given round. We have seen, as I said, the cadence of deals slowing down a bit, and I would say that companies are actually pulling back and trying not to go out to market right now if they can, and in some cases, in order to shore up their balance sheet, either opening up prior rounds or going back and doing insider rounds with their existing investors just to put more capital on the balance sheet to try and weather the storm, so to speak, with the uncertainty ahead in terms of the fundraising market. And to Alan's point, all of this is being driven by the public market, where if you can't see the valuations of the public markets, the private markets just follow that. So I think it's going to be a continued rocky road ahead. And if you're a founder looking to raise capital, I would say raise when you can, and be reasonable, be realistic, and it's better to sort of have more dry powder on the balance sheet now than not.
Gabby, thank you for that. Amanda, we see you've joined. Thank you. Glad it worked out. We gave a brief introduction, Amanda, but if you'd like to just spend a minute and tell people about yourself.
Sure. Firstly, most sincere apologies, New York traffic situations, but I'm glad to be here and thank you for hosting. Just very briefly, I'm Amanda. I'm in New York City. I'm with Founder Collective. We're a seed-focused fund, industry agnostic, and we love weird and wonderful founders with amazing big ideas. So that's just very briefly on us. Just to comment on, I think, what Gabby was saying and on the conversation at hand, I am strangely, or maybe not strangely, but I'm bullishly optimistic about what is actually happening in the market here. I think long term, this will be good for both founders and funders. I think there is a return to basic principles, a return to metrics, a return to being, capital conscious and not being incredibly capital intensive, and to making your money work for you. I think, like Gabby said, there is a return to valuations that I think will make more sense long term and help companies in the long run. I think there was so much of a focus on the present without thinking through, well, what am I going to need to prove and show by my next round? And do I have enough capital to get me there? So, I think slowing burn is going to be something that founders are going to need to focus on. And I think investors are going to be looking for capital efficient businesses, because whereas before you kind of knew that you would get funded, it's now a return to what have you done with the money? What can you show? And how are you going to make it last? But I think there are still amazing companies out there to be founded, to be built. I think there are incredible founders. And I also think the added benefit of, if you want to call it a slowdown, is I think it's good for everyone that funders and founders get a chance more than 24 hours to actually get to know each other and decide if they want to get married for the next 10 years. So I think there will be positive externalities, and I don't believe at all that it's all doom and gloom. I think some of the best businesses out there were built in rockier times.
Amanda, thank you. Travis?
Yeah, I mean, from my perspective, it's definitely a situation where everyone's sort of on a state of high alert. I feel like from a trends perspective, we're at a moment where you're seeing deal volume slow down a bit, just because there's a fundamental mismatch now between buyers and sellers in the market. And you have a lot of entrepreneurs that maybe had raised capital previously last year at a certain valuation. And it's hard for them to sort of say, oh my gosh, you're saying that the multiples now are here. Am I really comfortable at raising capital? And am I ready to do that already? Versus maybe they shored up capital last year and have a bit more runway to continue to push the business forward. And of course, on the investor side, you have investors seeing what's happening in the public markets. They're, seeing multiples change. And so they're trying to, rethink their, sort of underwriting cases to, what kind of rates of returns they can see from the entry multiples that they, pay when they make their initial investments. And so to me, it's just this settling that's happening in the market between the buyer-seller expectations, if you will, that's going to take time. And that's all being kind of still fortified a bit by the raises that were done last year, and still the ample amount of capital that's out there. So I think you'll see a lot of folks turn inward and continue to do internal rounds because they generally, a lot of the funds will still have the dry powder available to continue to support if they don't like the price that they're hearing from, potentially external rounds. And so I think that'll continue to extend the runway a little bit, where I do think actually valuations will probably continue to come down, more in Q4 of this year, even early, next year. And to some extent, the earlier stage stuff, there's the challenge sometimes here is you have a large proportion of investors that are non-traditional VC investors. And I think that's ticked up a lot over recent years. I saw a recent statistic that, 80% of the deal value in 2021 were non-traditional VC investors compared to 50% 10 years ago. So those folks can kind of retreat more easily than institutional investors that have committed funds and still need to put capital to work typically. And so that piece of it too, I think from a kind of current state of the union, we're going to continue to kind of see the effects of those folks, potentially retreating from the market as they sort of see what's going on in the public markets and have, sort of broader concerns.
Travis, thank you for that. Let's move on to the second topic and really dig down a little bit on specific advice for founders. So here we're going to be talking about what founders should be doing to increase their likelihood of financing in this environment. And as a first question for you all, I just say generally, in light of what we've just been discussing, how should founders be adjusting their efforts, whether in terms of their broad fundraising strategy or specific tactics in order to manage the current environment? Why don't we start with Amanda?
Sorry, I'm on mute. Sure. So I think I mentioned some of these, but I'll kind of summarize some of the thoughts I had here. I think number one and most important is hustle. With limited capital and fewer options, I think founders out there should be thinking very much about what is the MVP, what is the earliest, cheapest, most effective experiment I can do to prove out product market fit versus build and we hope they'll come. So I think I'm looking for, and not everyone fits into boxes and there are various flavors, but I think you're looking for someone who can make stuff happen out of nothing, someone who can move fast, and someone who can prove something relatively quickly. I think the sooner you can get to some form of metrics, it's really helpful. If it's a small beta group and you can show growth numbers or increased engagement or decreasing churn, anything that you can show like that, I think is important. I think being thoughtful and strategic about how you do your fundraise and who you go to is also important. I think you can run yourself into the ground going to every single fund out there. Figure out your shortlist, figure out who invests in that space and is actively investing now, because I think you can also burn yourself out going to talk to many funds out there who might not be writing checks in that space anymore, or are no longer investing at that stage. So I think be as much as VCs are deciding whether to meet with you, you should also be figuring out which VCs will really be worth your while. And I think stay positive, because I think the right fund, we're still actively investing. The right founders will get funded. It just might not. It might take a little bit longer. And I think, sorry, that's the last thing. I think just be realistic about timelines. If a Series A was going to take 3 weeks, it might be taking 6 weeks or even longer. If a seed was going to take, 2 weeks, it might now be taking closer to, not quite 2 months, but possibly somewhere around there. So I think just kind of be aware of what runway you need.
Amanda, thank you for that. And it's an important point you make about being aware of who you're going to. I've been advising my clients, especially in times like this, there's a need to really do diligence on the investor you're going to. You want to know who's still writing checks, who's taking a bit of a pause, who's maybe a little bit more focused on supporting their portfolio. It now more than ever, you need to use your time and make sure you're going to the right people. Travis, why don't we go to you?
Sure. I probably have 2 points on this. One, I think just having a kind of prepared contingency plan around use of capital in place, that when you speak with investors, that you already know that if your target raise is X amount, how far that capital will take you. And if things don't work out as well as you had planned, or if this market does soften and you don't ramp up as quickly at the top line as you had hoped, what types of contingency plans are in place to allow that capital to give you additional runway, so that you won't be out having to raise capital again from sort of a position of weakness, sooner than you'd like. So I think having that prepared, for your discussions with investors is critical. And I think the other thing is just a couple of things on the alignment front, given these market conditions. One, if you've raised previous capital from investors, I think getting alignment between yourself and those legacy investors around where did we raise capital? What was the post money of the last round? What are the terms of the convertible note? And let's have a realistic discussion of where things could land if we go raise capital right now, and so that expectations are set such that there's no major surprise when you get a term sheet or something of that nature, and all of a sudden your existing investors are sort of saying, "Hey, we didn't think we'd come in at this price. This is kind of surprising." I'd be very kind of careful on that front. And lastly, I would just say, even alignment with new investors. I was just on a conversation recently with an institutional investment firm that was post-term sheet in a deal and called the team and said, "Look, we have to haircut the price by 10%, just purely because of market conditions." Nothing had changed with the company. It was continuing to perform as expected, but it was an acknowledgement of what had happened in the market. And I think that was a surprise for the team. For the management team and for existing investors, and I think trying to align early on price and making sure that there's a really open dialogue on how your investor will view valuation in this environment, I think is critical up front, so that there's no surprises later on.
Travis, thank you for that. Gabby, your thoughts?
Yeah, I think Amanda and Travis are right on pretty much everything they said. I would echo, finding the right investor, being more realistic about timelines, being realistic and transparent about pricing. I think, expectations, like if people are sort of expecting deals to get done where they were getting done at the end of last year or early this year, I think, they're going to have a lot harder time finding a match than if they sort of realize where the market has landed and just sort of accept that. And I agree, making sure that you have enough runway, you're raising enough, money to take you, 2 years ideally, even in a down scenario. I think that that's really important. And I really liked what Amanda said about, sort of showing product market fit with the lowest, least possible like MVP, because, to sort of show traction rather than invest a lot of money building something that might not work, I think is even more critical right now.
Gabby, thanks. Alan?
I agree with everything the other three panelists said. Just want to add a couple of things. I think, even as the market gets a little bit tighter and tighter, I think, founders by their nature, I think there are two things that a lot of them don't understand. And they are, number one, how much capital do I really need to raise? And how am I going to deploy that capital, and how long should it last? And number two, I don't think they understand why investors say no more than they say yes. And, investors have certain, return expectations they have to achieve. And I think to ensure that investors, react positively to your business idea, I have a list of like 8 things that I think investors look for that I've tried to, advise my clients on before they go out to raise capital. And, they need to have a solid business plan. They need to be able to show evidence of product market fit. They need to ensure that the market they're selling into is large enough for them and for other competitors. They need to have a minimally viable product that's available. They need to show differentiation. They need to have evidence of strong leadership on the team, and hopefully leaders that have done it before and have had exits. They need to have some evidence of customer traction. And even though it's very early on, they need to be able to talk to investors about who the possible exits are going to be too. And I think those are the things that founders need to firmly understand before they go out to try to raise capital.
Thanks, Alan. I should just mention for the participants, we are open to taking questions. So please put your questions into the chat, the Q&A chat. All right. The next question I'd like to ask the group is, do you all see a general reorientation of what types of companies are going to get funded or more likely to get funded, business models? What do you see happening over the coming months in terms of your sort of recalibration of what the investment marketplace is looking at, what types of companies are most best positioned, I suppose. Why don't we start with Travis?
Sure. Yeah. I mean, I certainly, and I think it also dovetails well from the kind of some of the comments around valuation expectations. I would say to you that in the universe where we're playing, where businesses that are, as an example, B2B enterprise software businesses that have strong business model characteristics, strong CAC LTV ratios, strong attrition or lack of attrition, if you will, customer retention and growth. We're still seeing very strong multiples for those types of businesses. And so if you ask, and I think that starts to point to, is there going to be a major reorientation? I don't know. I mean, with these types of business cycles, generally our experience is that, obviously there's more of a discussion around, again, what is the plan to sort of achieve profitability on the long-term horizon, where maybe that wasn't even part of a discussion typically, or again, back to understanding how the business will become an actual business and not just a revenue generating machine. And I think that's the big change from my perspective, is there this sort of like flight to quality around companies that have contingency plans, are well capitalized, have strong business models, and are again focused on creating a business that's sustainable. And so typically we'll see kind of a transition around discussions of that in terms of the types of companies that get funded more quickly.
Thank you, Travis. Amanda?
I keep doing that. I think we're very much anti-thematic. We don't invest in themes. So I still don't think there are any industries that we are like, we won't touch that or we won't do that. I do think consumer has gotten tougher, just because I think with changes in iOS 14 and other, and other changes in kind of social media, the cost of acquisition has gone up. And so I think consumer companies are having a tougher time in the current funding market because it is tougher to have the outsized returns. I think we're seeing many companies as massive opportunity in the healthcare system to change models that are out there. Mental health is a huge issue that many founders are trying to solve and look at. I think carbon and ESG, these are more kind of trends and areas where we're seeing many companies, but I really don't think that there is an industry where investors are saying, I'm not going to look at that. But I think, to Travis' point, like, you've just got to show more. You've got to, and I would also say, address the elephants in the room. I often say this to founders, like, in your deck, in your conversation, I know that acquisition costs have gone up. I know there's high churn in this industry, but this is how we're addressing it. So I think acknowledging, what the hurdles are going to be, owning them, and explaining why you are differentiated and how you're going to get around them is really what becomes more important in a world where investors are thinking about, are you going to make it to the next round, and what is the story going to be that we tell to the world at the next round? So I think I often try to say to founders, like, if you're raising seed, where do you need to be at A? What could go wrong? How do you address all of that now, and how do you minimize risk and take risk out in as many places as possible? I think that funders, we're always taking risk every day. That's what we do. But I think when there are too many risks in this type of an environment, funders are more cautious.
Thank you, Amanda. Alan?
I agree with exactly what Amanda said, that I think, early stage investors are expecting to see more early on in a company's life cycle. I actually sit on the board of two angel investor groups, one in New Jersey, one in Philadelphia. And both of these groups, in their investment criteria, they have to see some evidence of revenues. They want to see some small amount of sustainable revenue. And that's for an angel group. So, it's interesting to see. They're expecting to see more at an early stage of a company. I also think, the word it was used many times this afternoon about capital efficiency. And I think, founders must understand how they're going to deploy capital and what goals are going to be achieved with that capital. They need to understand that very early on.
Thank you, Alan. Gabby?
She might be on mute.
Gabby, you're on mute. Can you hear us?
Sorry, I don't know how I forgot to unmute. I was just saying from an operational perspective, I think founders need to really think about, need to have versus nice to have, making sure that they're really focused on employing the right people for their point of evolution. So for example, if you are a founder that is testing around with product and haven't yet found product market fit, don't go hire a sales team. There's no need to hire business development if you haven't yet found product market fit. If you, to Amanda's point, are, doing a B2C company, doing customer acquisition, maybe be less aggressive in terms of the testing that you're doing to acquire customers and focus more on, high ROI opportunities. So I think just with, making sure that you're being practical and pragmatic, trying to conserve capital where you can, and doing, the right thing for the stage of the company is critical.
Thank you, Gabby. I have a question I'm going to sort of throw out to the group. We're running a little low on time, so I'll just ask maybe a couple of you to speak to this. The question is, from your experience, what are some of the most effective ways of showing traction? Whoever would like to jump in on that.
I can jump in. I think there's users, but then there's paying users. And to me, there's a big distinction between having tons of people, using the product versus people who are actually willing to pay something for the product. So I think, knowing that distinction is important. And I think the other thing is actually, we're obviously talking more kind of SaaS type businesses here, but engagement is a really important metric as well in terms of showing traction. So is your product being used once a month, or is it being used 5 times a day? It's going to be much stickier if it's used 5 times a day versus once a month. You're likely to have higher churn. So I think, if you're a B2B company where it's a much slower sales cycle, you're not going to get people paying in the beta, but you can show usage with 1 or 2 clients. That's fantastic. If you're a B2C company and you can get 50 consumers on and 60% of them are willing to pay, you're proving out something, you're showing something. So, I don't think the expectation is that with no capital, you can go out there and get thousands and thousands of customers. I think that's, not a realistic expectation. But I think any way you can show that customers are excited about the product, are engaged with the product, and are potentially willing to pay are helpful metrics. And it's so hard to kind of make blanket statements here because it really does depend on what industry you're building in.
Yeah. I would just quickly add that whether it's enterprise or on the consumer side, it's this building from Amanda's point. It's what is the consumer or the customer willing to pay more than once, and then showing that repetitive retention component, even if it's a small sample size of customers that they're coming back over and over again, whether they're renewing their license or their monthly subscription, whatever the business model is, I think is critical. And I would just say the other non-customer form attraction typically for us, is just the talent that you're attracting and that quality. And so to see that that a team is growing and that the quality of folks that the existing team is able to attract is of the highest level, to us shows an element of traction as well, because it continues to validate the potential for the company, the probability of execution, those types of things, is certainly important to us.
Travis, thank you for that. We're now going to go on to topic 3, specific advice on operational matters. So beyond financing, each of you works with founders in your portfolio companies. You speak to founders all the time that are looking for advice. What advice are you giving founders in this market, beyond how do you raise money? Like, are they, I'm sure people are talking about extending their runway and reducing their cash burn, but I mean, what are some of the conversations that you all are having with people on those more operational topics? Gabby, we could start with you.
Yeah, so I actually answered this question for the last question, so I'll just repeat what I answered. Being really focused on needs to have versus nice to have, like what you really need to execute your business plan, making sure that you're not investing in places where it doesn't make sense to invest at this present moment. So I gave the example of a company that doesn't have product market fit. You probably don't need to go out and hire a sales team or a chief revenue officer or head of business development. If you are a direct to consumer company or a direct to SMB and you're looking to acquire customers, perhaps being more focused on those really high ROI marketing channels as opposed to doing a lot of tests that might burn cash a bit quicker. So I think it's all about getting done what you need to get done, in the most frugal way possible, just so that you're not unnecessarily burning through cash.
Thank you for that. Alan, your thoughts?
Capital, I'm going to echo just like what Gabby just said. You're going to hear about capital efficiency. Try to get as much out of the money that's invested into your company. Don't expect to get paid a lot as a management team member early on in a company. I mean, I see this all the time when I meet with founders. They expect that a lot of that investment capital is going to go to pay their salaries and benefits. That doesn't happen. You're going to have a payday at the end because of your equity value, but don't expect to get paid a lot of money early on in a company.
Thanks. Travis?
I think we've hit this in a few different ways, but the one kind of maybe thing I'd add is just more of a reassurance component, and which is kind of giving the directive on down or collaborating with management teams on making sure that they're communicating to their teams the stability of the company, that there's plenty of that their investor partners are there to support the business through the long term. Particularly in this kind of war for talent, where if people get nervous that there's any trouble at the company, they're going to be, sort of 1 foot out the door. So I think there's just an increased focus on not only do you have to actually do the things that all the other panelists just described, but I think communicating out to your team, to your employee base, that, the company is stable, it's poised for continued growth. We're comfortable with managing through any challenges that come ahead, and we have investors that are here to support us. I think that's an important thing too, just to make sure everybody stays aligned and motivated, as we kind of go through this sort of rocky patch.
Thank you. Amanda?
Yeah, I think the only things I have to add there are, who are your top 10 customers? Who are your top 10 suppliers? Are any of them at risk? I think it's important to focus on that. That's something that we chat to our founders about. And then I also think looking at fixed versus variable costs, and both internally in your company and where you are in that sphere to another company. So, I think good old fashioned kind of accounting and account management and customer management is really important. You should be super close to your top customers. You should know what's going on in their businesses, because you should also know if, further down the supply chain, there are threats there. And to Gabby's point, don't overhire. That's a key one. Only hire what you absolutely need, and don't hire for the future.
The cardinal rule: better not to hire than to have to let them go, right?
Yeah.
And Paul, just to add one other thought, I think also you have to be aware of what your expectations are for your next round of capital. How much you're going to have to raise in your next round, 12 to 18 months later. So really understanding the cash flow of your business.
Got it. Thank you, Alan. We've got a few minutes left. We're going to hit our last topic on the topic of diversity. As we all know, even in the best of times, getting funded as a founder from a traditionally underrepresented group, whether it's women, people of color, LGBTQ, people with disabilities, is not easy. and that tends to become more difficult when the market goes down. So if each of you, just some quick perspectives, what should people in these traditionally underrepresented groups do, during this time to improve their odds? Why don't we start with Amanda?
Yeah, sorry, there's an echo here. I think, again, here I am optimistic. I'll give a shout out. I was at the Always conference last week, which was women investors. I think there's a huge shift and a huge focus for, minorities investing in minorities, women investing in women, and really supporting each other and building up. I think as we see this next generation of founders who will then become funders, it becomes a virtuous cycle. There are more role models, there are more people backing more founders. So, I would say I am hopeful that eventually we won't even be discussing this. I do think, it is still a concern. And I think, trying to find ways to connect with people beyond sometimes cold, you have to call. We've invested in many companies with cold inbound. Some of our best companies are cold inbound. It is harder, but don't be shy. But if a connection of a connection knows someone at a company that you think you should go to, use that and leverage it, and just really try tap any networks that you can, and be bold and ask someone to mentor or do an introduction. So I think, when the networks are not necessarily, I hate this term friends and family round, because for many people that is just not an option. And I think just being bold and leveraging any connections you have can be really helpful. But I hope we won't have this question in a few years. I'm very hopeful about that.
Amen to that, Amanda. Travis?
Yeah, I guess I would maybe just a broad brush comment then specific for kind of current day. I think on the traditional VC side, there's been kind of two things that have been going on. One, as Amanda alluded to, there's been an increase in the number of funds that are raised specifically with kind of DEI-oriented investment strategies, which are obviously a great source for folks to go to directly. I think on the traditional venture side, the reality is that the industry has been pretty inward focused over the last 24, 36 months of trying to look at establishing internal policies in their own firms, looking at their staff and their team and trying to understand how they can make it more diverse. So there's kind of been this inward focus initially. And as we see those firms continue to improve on those metrics and on the composition of their firms and how decisions are made, I think that's going to continue to trickle down to the benefit of all the entire entrepreneur universe. But it does take time. And I think that that's a piece that there's just a patience that we have to kind of continue to push forward hard on the traditional side. And, in sort of present day, building off the networking thing, in my experience too, it's just trying to surround yourself with top-notch advisors, whether it's great attorneys like we have on or accountants that we have on this call today, that can really help guide folks that may not be as familiar with this universe, and help them make the introductions to key players and reputable firms and reputable individuals. To me, that's a very critical component that can be very helpful, for entrepreneurs trying to build businesses in and around this topic.
Travis, thank you for that. For the attendees, I'll just note we're going to be wrapping in about 4 or 5 minutes. This is our last. Well, we have one more question after this. Gabby?
Yeah, I think that all the points that everyone brought up so far are right on. I think networking is critical. I think, associating yourself with people that have their own networks is critical. At the end of the day, I agree. I feel like this shouldn't be a conversation. It shouldn't be a question. I feel like another issue is that, we don't want to deter diverse founders from entering the market or starting companies. I feel like when you start with a smaller pool, it's hard to sort of, get that critical mass. So, if you're thinking about starting a company, I I think if we can encourage diverse founders to start businesses and they know that there's capital available, it will trickle down.
Thanks. Alan?
Here at Eisner Amper, we work with literally hundreds of private equity and venture capital firms, and I can't tell you any of them that have not had discussions with us on diversity, equity, inclusion, and also ESG initiatives. And here at Eisner Amper, we even hired last year a chief diversity officer, and we also hired a managing director in charge of our ESG practice. So we're working with many investor groups on these topics today. So we certainly understand the importance, and we're trying to make a difference in our own right.
Thank you, Alan. We're going to take a couple of minutes to wrap up, and if you could each take 30 seconds or so to give some final thoughts. Why don't we start with Gabby?
Yeah, I would say times may be a little bit tough, but it's not all doom and gloom. People are still writing checks into good companies. So getting to the point where you can prove, product market fit and that you're sort of succeeding on the customer side, I think getting there and then, being able to tell your story to investors is should be rewarded, should be fruitful.
Thank you, Gabby. Amanda?
Be kind to yourself. I think that's the last piece of advice. Being a founder is hard. It's lonely. You're breaking rules. You're expecting a lot from yourself. So I think be kind to yourself and find your tribe of fellow founders, because I think on this journey, it's so helpful to have others who are in the same boat, and just stay positive and look after your health.
Thank you. Alan?
I think it's a great time to be a founder, a lot of money still to be invested, and just surround yourself with great people and great advisors who can help you achieve your dream.
Oh, very good.
That
Travis?
was great, Alan. Love that.
Travis, you wrap up.
Yeah, no, look, I think great points by everybody here. It's been a fantastic discussion. I'm a long-term believer. I've been in this business since 1999. I mean, I'm a long-term believer that capital will follow great companies. And as everybody's alluded to, I think last numbers, there was $230 billion on the sidelines available. So I truly believe that great founders and great companies do get matched up with capital. So there's a ton to be optimistic for here. And I think if there's just a little bit of flexibility on both sides, generally with the investors and the entrepreneurs, great relationships are formed and great companies are formed. So I think there's still going to be a lot of good that comes out of 2022 and beyond.
All right, very good. Well, listen, thank you all. Thanks to the panel, Alan, Travis, Gabby, Amanda. Thank you for a great conversation on a lot of important topics. Thank you to the attendees for joining. We hope you got some value out of this. The networking will continue for another half hour until 1:30. So when you go, you can join the table of the, each of us has a table. For those who are, not all of us are able to stay, but those of us who stay will be at our table. So feel free to go over and chat further. Speaking personally, use my calendar link if you'd like to set up office hours. We will be distributing the video for this event. Keep an eye open for it, and feel free to pass it on to your friends and colleagues. And do keep an eye open for our future events. Doug, that's all I got. Any final thoughts on your side?
I just want to say thanks to you and everyone. Fantastic discussion, and really appreciate everyone taking the time to be here. We know you have other choices. So thanks, and hopefully everybody can continue networking afterwards. There was a question about how to get in touch with folks after here. Is there, should we leave that to the networking piece?
I think we'll be distributing the deck with people's contact information, Doug, right?
Got it. Okay. All right. Very good.
Okay.
Very good.
We'll make sure that contact information goes out soon.
Very good.
All right. Take care. Thank you all for joining.